On Hot Picks today, we are looking at transportation, and our guest has Union Pacific as his top ideas. He says synergies from a potential merger with Norfolk Southern could provide significant upside for investors. We're joined now by Ari Rosa, analyst at Citi. Ari, thanks very much indeed.
Yes, indeed. Thank you for having me.
Just update us, what is the latest on that potential merger between Union Pacific and Norfolk Southern?
So there's still a lot that's unknown. Union Pacific and Norfolk Southern, they submitted a merger application to the Surface Transportation Board, the STB. They did that in late December. And so now the STB is in the process of reviewing that. There's a 30-day comment period. And so we're expecting that by January 18th, they should have comments back. And so that'll be interesting to see what kind of feedback they provide. Of course, a lot of the competing railroads have raised all sorts of complaints and concerns, saying there's insufficient disclosures, that it doesn't discuss enough how it could impact competition, that they haven't provided enough detail around their synergy targets and what kind of business growth they expect to achieve. But look, I mean, it's a 7,000-page application, so it's not exactly lacking in lacking in information. It's just a question of are they providing the right information, and will the STB find that credible? And that's a question that, frankly, is going to play out over the course of the year. And so as we think about, we just issued last week, we issued our 2026 outlook. One of our predictions, it's not really going out too much on a limb, but this discussion around Union Pacific and Norfolk Southern really will dominate headlines across our space, at least, across the transportation landscape throughout the year.
But even if the merger is delayed or it doesn't even happen, you think Union Pacific looks like a decent stock right now?
Well, absolutely. So this is the reason really we like Union Pacific so much right now, is that it's kind of fallen into what we're calling deal purgatory, where the stock really hasn't done very much. You can see from that chart there. And yet the network is running phenomenally well. I mean, some people would say it's running the best that they've ever run in terms of network fluidity, efficiency metrics. And so they're doing a really nice job in terms of free cash flow generation. Their margins look solid. And so this is a business that, almost regardless of what the merger outcome ends up being, I think they're quite well positioned. And so relatively little downside and fairly attractive upside, which is kind of a setup that we tend to like. And then, of course, you have that extra kicker if you get the merger synergies that the company's been talking about. Now, in fairness, some of those won't materialize until 2028, 2029. But either way, Union Pacific looks like a stock that has relatively little downside risk and is just a very high quality business that continues to produce a lot of free cash flow.
Yeah, we're tight for time, and I'm sorry about that. United Parcel Service, UPS, despite competition that has pushed the PE multiple down, you see potential here.
Yeah, and so UPS pushes us a little further out on the risk spectrum, but UPS has a 6% dividend. So any of your retirees there, any of your long-term holders, I think they should be drawn to that. And frankly, look, we see the 6% dividend yield as too high. It should come down over time, and that, of course, should support the stock price. UPS was pretty explicit in coming out last quarter and saying, look, the dividend is safe. Our analysis suggests the balance sheet continues to be strong. And so it's a really nice dividend yield. It has some challenges. They're facing some questions around competition, but kind of at a fundamental basis, from a fundamental value basis, I think UPS looks attractive.
And then finally, a Canadian name. We're going to look at the New York listing, though, for a TFI International, a big trucking company.
Yeah, we really like the management at TFI. We have Mr. Alain Bedard, who's been a colorful character in the industry for years. But he's a really sharp operator and a really savvy business mind, where he focuses on the things that management teams, we wish more management teams would focus on those things, which is how do you drive shareholder returns? And so very focused on free cash flow, very focused on being opportunistic in terms of M&A opportunities. When everyone is down on the cycle, that's usually when he's most active. And so we think there's a lot of upside there. And particularly given some of the things that have been happening on the US side, where trucking rates have started to pick up because of some of the government enforcement actions, we think TFI is well positioned to benefit from that because, of course, they have quite a lot of business both in the US and in Canada.
That's interesting, yeah. And you say, I think you may have touched on this, but you say a good record of acquisitions.
Absolutely, yes. And so they've been very acquisitive, and that in turn has driven up earnings per share over time. They're very savvy about M&A and doing it opportunistically to drive kind of accretive earnings growth.
Thank you very much, Ari. Really appreciate it.
Of course, my pleasure.
Ari Rosa, analyst at Citi.